Good evening, everyone. This is a meeting of the Finance Subcommittee to continue a series of meetings that we've been holding relative to the Lowell High School, the impact on the tax rate, on businesses, and tonight we'll be discussing the city's debt service and potential cost effect on city debt service. So with us, we'll start with Mr. Clerk. Could you please call the roll?
Chairman Elliott.
Here.
Council Leary.
Here.
Council Milanazzo. Here. 3 present.
3 present. Also in the audience, we have City Council Rita Mercier, City Council Corey Belanger, along with the finance team, Mr. Healy, Mr. Baldwin, and Mr. Conley. So with that, there is a presentation that has been prepared. We appreciate this. I think they've been very helpful. It is available online for those folks that are watching at home or sometime in the after this meeting. It is available along with the other reports. Correct? Okay, good. So with that, why don't we just proceed with the presentation that is available. It's going to certainly be online and on cable. So with that, Mr. Baldwin.
Thank you very much, Mr. Chairman. So we're going to begin with a presentation. The discussion tonight is going to revolve around the high school project cost effect on the debt service. So the first chart here on the slide on the PowerPoint before you lays out the city's debt limit calculations. The debt limit is a statutory limit set by the state of the total amount of debt outstanding that a community can have. And for the folks watching at home, there's 2 major components. There's the regular debt limit, but there's also the double debt limit, which is set as a percentage of a community's equalized valuation. That's the total value of all property in a community. So the 5% of the equalized valuation is the debt limit, but there is also a double limit, which is 10%, and that is achievable by petition to the Municipal Finance Oversight Board. So communities can go up to that 10% if they petition the board. However, for the purposes of this discussion, we're sticking with the 5%. So in fiscal 16, which is the most recently certified equalized valuation for the city of Lowell, the total value of all properties in the city is $7.1 billion. The total outstanding debt as of the end of this most recent fiscal year is $236 million. When you take into consideration the amount of authorized and unissued debt, those are loan orders that have been authorized by the council, but the debt has not been issued or permanently financed, and you come down to the bottom line of the slide, it leaves the city with a remaining borrowing capacity under the 5% limit of $135 million. So double that would be the double limit. However, it's important to note that this only applies to purposes statutorily which are within the debt limit. So there are 2 major subsections of Chapter 44 that state purposes that are within and outside the debt limit. Most things you would think of for paving, building improvements, etc., those are within the debt limit. However, certain extraordinary expenses like water and sewer infrastructure under Section 8 of Chapter 44 are outside the debt limit and do not count towards that number that we have on the slide. Also, as it pertains to this conversation, debt authorized under Chapter 70B for school building projects is outside of the debt limit. So a project for the high school would be outside of that debt limit. It's important to note.
Okay. Can we just ask questions at this
Absolutely.
point? This is a lot, and I think it's, for me anyway, and I think our listening audience, it's good to just sort of recap it piece by piece, because this is very helpful. So the way communities can, there's a limit as to how much debt any community can bond. And at this point, and it's based upon the total valuation of property in the city, business, home, commercial, industrial, and residential. And in the city of Lowell, as of this past August, we have total valuation of $7.1 billion in valuation.
Correct.
Of that, we can bond 5%, and that would be $358 million.
Correct.
That's the most that we can. Currently, we're at 236 plus the 84. Correct?
Yes.
We have total outstanding debt already, that's bonded for 236 million. And then there's still additional debt that still has to be issued in the form of bonds. So we are at 320 million.
That's correct, Mr.
Okay.
Chair.
Good. So, any other questions? We got Mr. Councilman Lazo. Oh,
Thank you. Just getting back to the point about the water and sewer is outside the debt limit, so that $84,700 does not include any CSO funds that we had borrowed?
The major portion of that $84 million, I think it's listed below approximate amount of authorized unissued debt outside of the debt limit.
Okay.
The majority of that is the CSO work.
It is?
Yes.
Okay. Okay.
Which will be permanently financed very soon. The projects are ongoing, and bonds will be sold to permanently finance that work.
Okay. Okay. Thank you, Mr. Chair.
so can we just take that one step further, Mr. Baldwin? So what outside the debt limit means is the city of Lowell and its general fund, we can bond a certain amount of money, which we just went over, outside the debt limit for water and sewer, because they're enterprise funds. That's not, it is considered, but it's not considered part of the amount that we can bond, correct?
Statutorily, it's not considered
Okay.
part of the debt
Mr.
limit.
Healy?
Generally paid for by user fees.
Right.
So it's,
Right. So the users are City of Lowell taxpayers, whether it's business or otherwise, but for instance,
And the
our
university.
hospitals and our universities, they consume lots of water, and we have to bond for that. But I just want to continue to make some things clear that, for my own self, that just to make sure. So
That's correct, Mr.
I
Chair.
think we're good.
Okay.
Council Belanger? Council Larry, we good? We good to go? Okay. So,
Okay.
next line item.
So again, I understand this is a lot to take in. There's a lot of numbers here, a lot of very technical information, so please feel free to ask questions as we move along. The next chart here displays the forecasted debt, including the high school and the projects included in the city's 5-year capital plan, and displays them as a percent of general fund expenditures. So these are only general fund expenses, and the Government Finance Officers of America, there is a best practice not to exceed 10% of your general fund expenditures, or revenue. Right now, as you can see in 2017, we're at about 3%, and that's debt service as a percentage of our total expenditures in the budget. As we move forward, you'll see there's a red portion. The blue is what's existing now, and you can see that does start to decline as we go over the 5-year forecasted period. The red portion of the bars is the capital plan debt service. So those are for projects that have been included in the capital plan that was presented to the council last year and continues to be presented each year for a loan order authorization. And then that green bar that you see start to come online in 2020 is the debt service for the Lowell High School project. Now, for the purposes of this chart, we took an average of the debt service of the 4 options that have been advanced by the council. So you can see that by the time we have the full effect of the debt service on the high school and the debt service for the capital plan, we get to about 6% of expenditures in the year 2022.
Mr. Baldwin, what's that average figure that you used?
I'm sorry, say that again?
The average figure for the high school debt? Of the 3?
I want to say it was somewhere in the area of $8 to $9 million debt service. That's principal and interest. It does vary from the full renovation to the Colley option, but the average is somewhere around $8 million debt service.
Okay, thank you.
Mr. Chair, I think it is important to, as you look at that chart, you can see that attention is still being paid to the other capital needs in the city. As debt drops off, as that blue table declines, the brick red is replacing that. So other infrastructure investments will occur. The high school project being so significant just stands above the rest.
But those are assumptions that you're building in that will continue to have to make investments in the city, no matter, whether it's streets, roads, sidewalks, or whatever the case. But what is interesting is that in 2020, that our existing debt starts to drop off significantly right through 2022. That's somewhat of a positive sign that we have paid a lot of our bills, and then it's going to drop off to help with the high school.
That's absolutely right, Mr. Chair. And the policy of the city manager, the administration, and the finance team has been to match up the 5-year capital plan by adding on new debt as existing debt starts to come off the books, so as to keep that level of debt service somewhat even, so as not to additionally burden the operating budget.
Yeah, and I think that's a good point, Mr. Baldwin, that residents and taxpayers should know is because we do have discussions sometimes. Why are we spending this much money? Why are we not? Because if we don't keep it at around 3%, then we have sort of major problems, sort of like what we're dealing with right now. So it's important to continue to do some improvements throughout the years. Thank you.
So
Questions on this graph by members? No? Okay. Mr. Baldwin?
Moving on, there were some additional questions that had come up from the council, I believe, particularly from Councilor Belanger, on some additional large-scale capital projects that have been considered by the City Council, however, are not included in our formal 5-year capital plan. One of the largest of which was the renovation of the police station, and then the combined police DPW. A feasibility study was conducted a year or so ago where we got some hard numbers, so we were able to, from that, pull some projected debt service costs for that. These were not included in that graph that was just presented. However, the debt service for a $55 million police station would be about $3.5 million a year for 30 years, and the debt service for a $96 million combined DPW police station would be about $6.2 million a year. So if that were something that the council wanted to consider, that would be on top of what you just saw in that 5-year projection. The next slide here just kind of pulls out the debt impact. The debt service, again, is for the high school is based on the average of the 4 options. You can see that the blue portion of the bar is the existing general fund debt. In the operating budget, this does not include debt service for the enterprise funds, which is paid by the enterprise fund and therefore passed along to the rate payer as a user fee. Each portion of the bar, the different colors, represents a different year of the capital plan. And just to talk a little bit about the 5-year plan, that really represents what we believe is the full amount necessary to maintain our capital infrastructure. It maintains a large portion of additional paving work to supplement the Chapter 90 money received from the state to improve the roads and sidewalks. It includes, improvements to buildings throughout the city, various parks projects, etc. The city went through a pretty exhaustive process to try to get all the capital needs of the city into that 5-year plan. So this really represents the needs of the city from 2018 through 2025. And then that pink or peach portion of the bar on top represents the high school debt.
So, Mr. Baldwin, just a question. Can I ask you, as of this fiscal year, 2018, we're looking at about $8 million in debt service. And it stays relatively consistent through the next several years up to 2023, and then it does drop off significantly, almost to the point where it's around $4 million in 2025. What are the projects that are in the pipeline right now, and what will be paid for when we see that be rather significant reduction in debt? Would you know what exactly the projects are?
Offhand, a lot of these are, like I just mentioned, for building improvements, for paving, and each one of those has a different term that's allowable under the statute. So, paving work can be borrowed for a term longer than departmental equipment. So you'll see, if you can borrow for 5 years for equipment upgrades for vehicles or for hardware, software for city departments, that debt will come off before the debt for a building project that would last something like 30 years. That would stay on for longer.
Okay, and I understand they're grouped. We don't just go out for loan order for, say, a fire engine or for snow plows or things of that nature. We do group them together because it saves money on the administrative costs as well as we get a better rate.
Yes, that's exactly right. And we try to play the market as best we can to take advantage of interest rates, which is a whole nother sort of piece of this discussion, is that our projections are based on a number of assumptions. And right now, we've been in consultation with our financial advisors that it looks like rates are going to increase, and they may increase significantly over the next few years in terms of interest costs we would pay on borrowing. It's all sort of conjecture, but we're...
I guess the question is, what are you projecting as an increase? Because you're right, they already have gone up, and they're going to go up again, but what are you projecting in 2022, I guess?
So to your point, Counselor, on the next slide here, which is on the television now, we have for the bonds dated September 1st, 2018, a 4% interest rate, 2019, 4.25%, and then as we get to 2021, 4.5%. Now, obviously, that's subject to change. We think that's fairly conservative. It could go, and we would update these projections each year as we move forward. But when it comes to the high school debt, I think we were using a 5% interest rate or 4.5%. Just to try to be conservative, we would much rather plan on it being a little more expensive, and then as we go out to market to sell the bonds, be surprised that it's less expensive, but we want to make sure that we hedge for the downside.
Just to follow, so this is coming from our financial advisors, and ultimately that this is the projections we should be, and ultimately, hopefully, it'll come under, but not over. So that's the goal then. We'd rather have enough in place as opposed to the reverse.
Right, you don't want to underguess.
Obviously, but I mean, do you feel comfortable with these numbers, Mr. Healy? I mean, again, that's the...
Yeah, I think this is as good a prediction as anybody could make right now.
Okay, thank you.
Oh, I'm sorry, Council Bland, you had a question.
Thank you, Mr. Chairman. Mr. Chairman, through you to Connor again. Connor, if we can go back to page 2, as to remaining borrowing capacity under the debt limit is about $135 million. You said that can be exceeded for municipal projects, correct? Such as high school and...
That's correct. So for high school building projects or school building projects in general, the debt associated with that by virtue, it's statutorily outside of the debt limit.
Okay.
However, that 5% can be doubled to the 10% upon petition to the MFOE.
Right, I get that. Okay, but what is, if we don't petition, what is the amount? How much can we increase it? What is the formula, I guess, is what I'm asking? If we can exceed that limit, by how much, and what's the formula?
Counselor, with the school projects, there essentially is, the limit would be based on what you can afford, essentially. So
okay.
the 135 really wouldn't come into play as it relates to the high school
So
project.
that's basically comes down to your call, gentlemen. Okay, all right, thank you.
Councilman Milanazo?
If I could just follow up on Council Belanger's question, understanding that the 135 is outside of the debt limit, but when we're at a point where we're actually approving the bond authorization for the high school, giving you all permission to go out and draw down funds, they're going to be drawn down over the course of the construction. So does that 135, if it counted toward the 5%, would that actually count? Would that begin counting that the first year? Or if you, as an example, if you drew down $25 million the first year, that would increase the limit by 25 million, and not necessarily the...
It's based on the total amount that's authorized. So
Okay.
if you authorize a $140 million local share of a loan order, it would
Okay.
be that amount. However, when we get to that point, this chart here, is for discussion purposes,
Right.
but it's as we sit here today. Now, we will have debt that will come off the books by the time the city council considers a loan order. So those numbers could change and might be a little bit different at that point.
Okay, thank you.
All set, Mr. Baldwin?
If I may, Mr. Chair, you had brought up a point that I think is worth discussing a little bit. The financing strategy for paying for the whatever the loan order is, just because it's authorized, we don't have to permanently finance the entire amount all at once. And the council and the city manager do have some flexibility to finance it in a way so as to make it the most affordable for the operating budget by financing pieces of it as we move through the construction phase of the project.
Mr. Chairman?
Council Belanger?
Can I touch on one question? Now, Mr. Chairman, through you to Connor once again now. So it sounds like we're able to structure this bond, if you will, Connor, where we can incrementally tier payments to the city where it's easier on the taxpayer and those who are on a fixed income early in the loan. I understand when the project is completed, you'll have spent everything that's been allocated, and then but are we able to start off with lower payments for the first few years and then incrementally, I guess is what I'm asking?
There is some flexibility we have to issue short-term financing in the beginning, bond anticipation notes. The recent changes to the Municipal Modernization Act allowed for some bands the maximum term used to be about 5 years, I think. They've extended that to 10. And you can continue to draw down new money, essentially, to push that back. So there's a number of financing options, financing strategies that can be considered. It's still very early in the process to talk about those in too much detail. But, we'll certainly work with our outside financial advisors and folks who are a little more familiar with the market at that time, so as, like I said before, to ensure the least impact on the operating budget.
Okay, great. Thank
And
you.
I know that's looking ahead to the future, but you don't want to stretch it out so far that the debt payments are still due for several years after the SBA payments stop being received, because those are a constant over time. And you can ban early on in the process to meet the cash flow for the construction costs. But before the project is completed, I would think some of the first portion would probably be permanently financed, but you would continue a ban process.
Yes, I get that.
As long as it's feasible and you weren't paying more in interest than you otherwise would.
Okay, all right. Well, it sounds like we do have some flexibility in the early beginning to help. So that sounds good. So we'll be looking to you for some creative financing, gentlemen, and we know you're up to the task. Thank you.
Well, look, I'd like that word of caution, Mr. Healy. I think it's important because I think our SBA reimbursement for the high schools that we went out to years and years ago stopped or they expired a number of years ago. Pardon me. And we still have debt that we're paying for on some of our schools. So we've gotten all the reimbursement back from the state, and we still have debt. So I also think it's important, yes, we can use some bond anticipation notes, but just to address the cash flow. But, at the end of the day, we want to make sure in layman's, it's just, we want to pair our reimbursements from the state to offset the debt that we have from the school, and that it's not, well, we're not going to, we're going to get the reimbursements to fund operating. But, oh, by the way, we're going to have 10
It would
years
be staged in a very cautious and balanced fashion to achieve that.
Right. Good. I think that's important to keep in mind. Next slide.
Okay, so finally we have the general fund forecast. These numbers and this forecast is the same as was included in the fiscal 18 budget, which will be presented to the City Council this evening. We update this every year. We've included the assumptions on this slide, but essentially it shows the fund balance in the general fund out to 2023. The first slide here is dedicated solely to revenues. It's important to note that Lowell, only 37% of the total revenue in the city comes from the tax levy, as opposed to the median and the average in the state, which is closer to 2/3, about 67%. So the amount in Lowell is more heavily dependent on local aid, et cetera, as the total amount of revenue. So this forecast is based on a number of assumptions, as I mentioned. And as we move through the escalation, this is probably really hard to see for the folks at home, but it's important to note the bottom line there that several matters will need to be discussed in order to balance out the general fund once we start taking on the debt, whether those options are moving projects further out in the capital plan, or obviously the city manager and the finance team will look every year, as we always do, to savings we can achieve in operational areas, holding the line on overtime and on other expenses, working with our energy manager to try to save money on energy in city buildings. But it is a matter that will need to be addressed as we move forward in terms of keeping the general fund in balance.
Councilman Lazo, but can you please, I think it's worthy to note and worthy to have you repeat exactly how you started this presentation, that, comparing the city to other communities, where we are financially with our debt is a good thing. So, and I'm sorry, Councilman Lazo, I just want to have, I just want you to reiterate that.
The 3% of
Right.
expenditures. So earlier we talked about currently in the current fiscal year, our debt service budget is about 3% of the total general fund expenditures. As we move forward, it will make up a larger percentage. So right now, the general fund budget for debt, principal and interest, is approximately $10 million. And the debt service for the Lowell High School projects, any of the options, is somewhere around that same number.
Through you, Mr. Chairman, if I could, to Connor Baldwin, the numbers that you have up on this slide here, where you're showing, again, negative number of 6.3 million in 2019 and jumps up to 17.5 million in 2020. Does that reflect the city being at the tax levy limit, or are we still below the tax levy? Because we're below the tax levy by about $16 million, I think.
That's right, and that's a very good point, Councilor, that currently in fiscal 17, the city has excess levy capacity, or the amount below the state limit that a community can tax. We're lower than that limit by $16.5 million. So the assumptions that are included in this forecast presume a 2.5% increase in the levy each year, which has not been the case, and typically we try to limit that tax increase as best possible, but those are just the assumptions that are included in this forecast. And each year that you'll see in 2019, the $6.3 million number, that's a number we can work with. I mean, we can bring that down. We've brought down a bigger number than that just by sort of limiting departmental requests. Some of these assumptions don't necessarily come to fruition. Perhaps the pension assessment is a little bit less than we thought, or perhaps snow and ice isn't as bad as we thought. Those things are subject to change.
And just to follow that through, as you look at 2020 and 21, the assumption is for a 2.5% growth, but with the debt on the high school, that's not possible. The red number of 17 million and 18 million, you can't keep working magic. Those are real red numbers. So the levy would need to grow to support the debt.
Okay, further questions? Okay. It's a lot. That's right.
That's the end of the presentation that we prepared. Certainly, we'll be happy to answer any questions that you may have, but that's all we got.
I know that's not part of the packet of information that you have, but generally speaking, outside of the Lowell High School, what amount of debt, and I know it fluctuates from year to year based upon what we approve in the capital plan, but generally speaking, what is the investment that we make for various capital projects, whether it's school roofs at the middle schools, or those line items for voting machines, and I'm just trying to think of some items that are coming up in a couple of years. Mr. Conley?
Through you, Chairman. So for example, in the recently introduced FY18 loan order, that was $11 million in bond authorization.
Okay. So is
That's
that
pretty
a
consistent with
static
what we're
number?
looking at,
Yeah.
around that 8 to 12 million over the next couple of years.
Okay. Gotcha. Councilor Belanger?
Yes, thank you, Mr. Chairman. Mr. Chairman, through you to Connor Baldwin again. Now, Connor, back to the remaining borrowing capacity again, 135 million. We can exceed that for a school building project, and it's basically an arbitrary call made by the city, and we're certainly going to lean on your finance team to make that call. So beyond that 135 number, the 135 million, what do you estimate is when the city, do you not recommend we extend our debt any higher than that? Because I want to know capacity to do a police station down the road if we take on. So do you have that yet, or do you need to do more further research?
Well, I think that's certainly something we can do a little bit more analytics on. However, I think it makes me think of the slide we have here as the debt as a percentage of the general fund expenditures. That's really the measure that we should be looking at.
Yep.
The 10% is the ceiling that the GFOA recommends. However, for a community like Lowell, where our socioeconomic makeup is such that we try to limit the average single-family tax bill to a certain amount, and the year-over-year tax increase, we should really be between that 4 to 5%, maybe half of that 10%, as sort of a sweet spot for how much debt service we have in the budget as a percentage of the total general fund expenditures.
Okay.
And if you just tried to project out on that 5.8% in 2022 and on this chart, if you added 6.2 million for the Public Works Police project, that
Right.
would pierce the 8% mark probably, which
Gotcha,
is
that's what I want to know,
getting
Mr. Haley, yeah.
dangerously close.
Absolutely, that's what I'm trying to get at. What are we going to be able to afford after this project? That is my point. The police station is in deplorable condition as well. We need education takes precedent, but what is going to be our capacity at this approximate 135 million that we're looking at as it stands right now? So, okay, if you can break that down for the next meeting, Connor, you know what I'm looking for. I think you understand my request, if you can sort of break it down to include other capital projects, in particular the police station, just to see capability to do such other capital projects with taking on the high school. So thank you very much.
We can absolutely do that, Counselor, and we also will have forthcoming, there was a request by this subcommittee to discuss the new value coming on from the TIF agreements expiring. We'll have a response to that request coming in the next week or so.
And when does that come in? And I know this committee made that recommendation. Is significant, particularly as we look at 2019 and 2021, and then thereafter, where there's a significant increase in and the money that we're going to need to run the city. Is there significant valuation coming online as a result of those?
As we get to the sort of 2018 through 2020, all of the TIF agreements are structured in different intervals, so it will be different each year as we move forward. However, we're looking at about $400,000 to $500,000 in new value that will be taxable and coming on the books in the 2019, which is a significant amount of additional tax revenue received by the city that will help ease the burden on the residential class of properties.
As a preview of coming attractions, there is a chart on TIF in the budget you're about to receive in 10 minutes or so.
And in addition to the TIFs, we assume a built-in assumption of, is it $1 million, 1.5 for new growth? And I know, and I appreciate the fact that when developing the budget, that is a conservative number, and typically we exceed it rather than come up short at the end of the year. Is it about 1.5 million that we anticipate in new growth, whether that's permits, businesses,
For
construction?
the 18 budget, we're expecting 2.5. However, when we look for the long-term forecasting, obviously, we try to be extra conservative, so it's about 1.6 that we project out.
Okay. And there's one unknown in here, and I understand it's difficult for you to plug that number. The pension assessments, you're using the 2015 annual and then a percentage thereafter for growth. That comes from PARAC, right? And do we have,
This is our current schedule as most recently received from PARAC based on their most recent actuarial report. So we will be fully funded. Our pension obligation and the ARC will be fully funded in 2036. At that point, we'll essentially be paying as you go.
The only
we've had some
bad
big-
news on that is that all actuarials are now advising communities to lower their rate of return estimate on an annual basis and change to a due table of mortality. So every 2 years, you have a new actuarial done, which modifies the. Now, we're sound on a PERAC number through next year at least. That Connor's estimate is fine for that. After that, we'll have a new actuarial. But unfortunately, that's a bit of a moving target, but I think it's adequately projected in this forecast.
that's a tough moving target. I mean, we've had some pretty big
Yeah.
spikes in the last couple of years. And who's the retirement board of which you're a member set what the expectations are, correct?
Right, and after the date of the most recent actuarial update, I think some of the members of the council will remember, I think that was 2015, it was about a $3 million spike due to an updated mortality table and some of the things that it sounds like they're recommending happen again. So it's reasonable to expect that it will change again.
And what are they based that on? What are the projections? I mean, what's the data that they look at? I mean, it's clearly driven in large part on market forces out of
The
country.
big one has been rate of return, and retirement boards had been using a figure at 8 or above,
Yeah.
which is not achievable these days. And the conservative estimate is at least be below 7.75, and ideally at 7.5. So that's, and obviously the board itself makes those decisions.
And where is the city's retirement percentage?
On their current actuarial, I'm not sure.
Okay.
I think it's somewhere around 60 or 70%. I don't know off the top of my head. We could certainly report back to the
Okay.
council with that
Just
number.
out of curiosity,
Sure.
just to know, because that's we've been very good with our finances, but the pension liability that's been the budget buster in the last couple of years. And as you said, it's somewhat out of our control, but to be conservative on our estimates, because we have to make the balance up in the levy. Okay. Questions from we have Council Samaras, Council Rourke that have joined us as well. Other questions on this report? Members of the subcommittee? Okay, I think this is important. It was very informative for me, and I know the committee and other members that have joined us as we move forward in this discussion, as well as any other capital improvement plans that we have that we'll be discussing this evening and in the future. So, no motions to bring forward. Motion by Councilor Milanazzo to bring this forward to the full council as a report of progress, seconded by Councilor Leary. All those in favor signify by saying aye. And the opposed, that motion carries. If there's no further business before the Finance Subcommittee, entertain a motion to adjourn by Councilor Milanazzo, seconded by Councilor Leary. All those in favor signify by saying aye. And the opposed, this meeting stands adjourned.